Hi, my name is John Mashni. I'm a partner at Taylor English, and today I'm going to be explaining what an S corporation is and how it differs from what some people call a C corporation or just regular corporation. So first of all, very nice to be explaining this all to you. This is a really common question that comes up a lot of times when we're advising people about entity selection, and even sometimes where the entity's been around. Sometimes they ask this question, they hear about it, should I make an S election? There's a lot of details that go into this, and I think it's very, very case specific, but I just want to explain first, what is an S corporation? Corporations or entities are allowed to elect how they are taxed. And there are some default ways that they're taxed. So for example, if you're a partnership, you're naturally, or you're by default taxed as a partnership. You're a multi-member LLC, by default, you're taxed as a partnership. If you're a corporation, by default, you are taxed as what sometimes people call a C corporation. You can make an election, though, an affirmative election. You file a form with the IRS, and you can make an election to be taxed differently. So you can actually, as an LLC, you can elect to be taxed as a corporation. As a corporation, you can elect to be taxed as a partnership. And one of the elections that you can make is to be taxed as what's called an S corporation. An S corporation, it has some of the benefits of being taxed as a corporation, a C Corp, and then some of the benefits of being taxed like a partnership. An S corporation allows you to have what's called pass-through taxation. So there's one level of tax. You're not taxed at any level. Those taxes get passed through to the S corporation shareholders. So there's a lot of advantages and some actually disadvantages as to making this election. So a couple of the big ones, and I don't think there's time to really dive into every single case here, but a couple of the big things I think people should really be aware of with an S corporation. Number one is there's limitations on who can actually be S corporation shareholders. And if you have a shareholder or owner that is not one of those approved shareholders, then you can actually do something. You can break that S election, or sometimes you say you ruin your S election, and then you actually go back to being taxed as a corporation, which means there's two levels of tax, and usually you pay much higher taxes. Not always, but usually you would pay much higher taxes, so you don't want to ruin or negate that S election. So number one, you really have to be careful. You have limited types of shareholders, and usually it's an individual of some type. Some, in limited cases, entities can be shareholders, but usually it's an individual, a person, a naturally existing person. Some trusts are eligible too. So that's something to be aware of. You're limiting who can actually own equity in the S corporation, number one. Number two, there's something called the single class of stock rule, which means that all distributions to the shareholders in the S corporation have to be equal. You can't have unequal distributions like you can in a corporation. You can have different classes of shareholders. You can't do that in an S corporation. And you have to make sure that, and you can even do that in a partnership, for example. You can have different allocations of income and deduction. So that's one thing to remember. And you can sometimes ruin or break that S election by mistake, right? You might say, oh, well, this particular shareholder, they have to be allocated a little bit more, or they have to be paid a little bit more outside of a salary. And that can actually sometimes ruin that S election and result in a big tax bill. So the two big things that I think people should really be aware of is that limitation on S corporation shareholder eligibility, and then also on this idea of the single class of stock rule. You have to make sure that distributions are correlated with the equity percentage or the amount of ownership. And really, those two things can lead to all the other things to talk about, right? And a lot of times you want to be very careful when you're thinking about what goes into making that S election. Some general rules, these don't apply all the time, but I think you got to be really careful anytime you're going to have real estate in an S corporation. And it's much more difficult to get losses out of S corporations. But if you have profit and you're making money, sometimes it can really make sense once you run the numbers to make that S election. There are some extra, what we call sometimes administrative burdens of doing it. Like, so if you're doing work in the S corporation, you should pay yourself a salary and actually run payroll, which is different than in a lot of LLCs or partnerships. So there's a little bit of administrative cost and burden, but if when you run the numbers, sometimes it can really make sense. So that's where I really recommend talking to your legal and tax advisors to determine, should we make an S election or not? And you can even figure out pretty exactly like what's the cost benefit analysis. Does it make sense? What type of entity makes sense? A lot of times startups, you're always wondering, how can I pay the least in taxes? This is one way to save in taxes, but there's pros and cons. So we always counsel people to be really careful when they're looking at entity selection, and don't just look at taxes either. Sometimes if you're looking for investors, they will or they won't invest in an S corporation. So really pay attention to what your long-term vision is and what you're trying to do. So I hope that's made at least give you a little bit more info to work with your tax advisors and your legal advisors on whether you think an S election makes sense for you. Again, this is John Mashni from Taylor English, and hopefully this helps you out.